the supply can't keep up with the demand, so prices are going up. And they're going to keep going up until people stop wanting to buy gas. Baby formula. I just saw it on the news this morning. They're enacting price gouging laws to prevent people from overcharging for baby formula. Why? Not because there's 30% more babies overnight, but there's 30% less inventory because of shipping issues. And there was a major baby formula factory. I didn't even realize this, that closed earlier this year for some issues, and they're allowing them to produce goods again. So supply and demand is what controls any market. I don't care if it's apples, houses, gas, baby formula. It doesn't matter what it is. Cryptocurrency. The only reason that's going up and down is because one day somebody wants to sell it. More people want to sell it than more people want to buy it. The price goes down. If more people want to buy it than want to sell it, the price goes up. Right now, today, as we sit here and do this show, and you ask this wonderful question, there's more demand than there is supply. More people want to buy, even at 5.5%, than want to sell. And as a matter of fact, a lot of people, and I'm going to encourage you to hit the Facebook page and watch that video, and I go into length on why I don't think the housing market is going to crash. Most people think because interest rates are going up, the market's going to teeter. Well, it may slow demand, but it may also slow supply. This is kind of the quiet part that nobody's saying out loud. If I'm sitting tight in my house and I've got a ton of equity, but I refinanced 2 years ago or 18 months ago, and I've got a super low interest rate, I got 2.9% 30-year fixed rate. Why do I want to sell right now? I certainly don't want to sell and buy into an overheated market and pay a higher interest rate for a higher valued property. I can't even move laterally right now and have it make sense. So I'm no longer a move up buyer. If interest rates continue to move up, I think it may even temper some sellers from entering the market. Builders still can't get garage doors. They can't get appliances. They're still lacking the fixtures necessary to complete the homes for delivery. That's a supply side pressure. Interest rates alone will not control the supply and the demand. It may eventually temper the demand, but until the market becomes balanced, which it's nowhere near balanced right now, it's not going to tip the other way. Things are cooling. There's no question about it. I think you're going to see more seller concessions. I think sellers will be willing to use that buy down strategy that we mentioned on the last question. I think sellers may be willing to pay closing costs. Sellers may even be able to be willing to take less than asking price, but none of that means a bubble's going to burst. That means the market's going to temper, and appreciation is not going to be 20%. It might be 6% or 8%, and there'll be a deal here and there out there. You know, Mr. and Mrs. Johnson, who lived in the neighborhood for 50 years and paid $85,000 for their house that's now worth $700,000. If they die and the kids inherit that house, yeah, somebody might be able to talk them into selling it to them for $500,000. That's $200,000 under market or $300,000 under market. Is that an indication that the market's going down, or that somebody had a ton of equity and was willing to take less? So until supply and demand balance and then tip in the other direction, I don't think we're in a situation where a bubble bursting scenario exists. And you know, the cost of money is designed to temper demand, which it may do, but it's not designed to fix any of the supply side issues, which are what it currently is driving the home value. So I throw that out there. There's some great videos on the Facebook page where I go into that topic in particular in length. So hit the Facebook page, The Mr. Mortgage Show on Facebook, and you'll be able to deep dive that. And if you'd like to talk with me off the air, I'd be happy to have a conversation with you. I'm open to any direction the conversation goes, and I'm certainly not biased to data. So 561-291-8569, get your questions on the air, and we will be right back after this short break. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right. We are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and you heard the man. You can get the questions that you have pending that are burning a hole in your mind. Shoot them to us to 561-291-8569, 561-291-8569, or visit us online at www.mr.mortgage. Actually, you don't even have to type in the www. I challenge you. Try this. Go up to your browser, Google, Chrome, whatever you're using. Or Chrome is Google, I guess. Anyway, type in Mr.Mortgage and see what happens. We will pop up. So you can always submit your questions to us there. But we are going to try to do a rapid round of questions. I saw a few stack up as I went a little long on the economy, but I think that warranted a detailed explanation. So let me throw it over to Dom for some questions.
Abby sent this question in just now. We're looking at a duplex as an investment property. Can you explain the investor loan you talk about? I think it's a VSR loan.
Hey, Abby, that's a great question. It's actually called a DSCR loan. And what that means is debt service coverage ratio. And what a debt service coverage ratio is, it's the amount of income from a property against the amount of debt, or monthly debt rather, the monthly payments of that property, your principal, your interest, your taxes, insurance, if there's any HOA fees. You take every expense against the property and the income associated with it, and that's a ratio. So the cool thing is the DSCR loan that we talk about, which is awesome for first-time investors, with a down payment of, depending on credit score and program, 75 to 80% loan amount, so 20 to 25% down payment. We're only looking at the income from the property. So if the expenses of the property are $2,500 a month and the rent is $2,500 a month, we consider that cash flow neutral, and you can purchase that property. So basically add up all of the monthly expenses against the property, and you're looking for a 1-to-1 or better. Obviously, for you as an investor, as many times over that one that you can make that ratio work to your advantage makes more sense. So if it's a $5,000 income against a $2,500 expense, that's a 2-to-1 ratio, which is an awesome investment. So hopefully that answers your question, but look at the monthly debt and how the rental income covers that. And I encourage you to give us a shout if you need additional information. So let's keep this rolling.
Drew just called asking, how do I get more information about the lease option program?
Call me. That's the easiest way to do it, but I'll give you a snippet of it right now. So the lease option program that I'm pretty excited about is you find the property that you like. It can be on the market, listed with an agent. It can be a for sale by owner. You can knock on your neighbor's door and convince them to sell you their house. Or you could be renting the house and wanting to buy it from your landlord. Assuming the property meets the requirements, there is an inspection. They prefer single family homes instead of, basically fee simple is what they're looking for. If the condo or townhouse is fee simple, they'll also buy it. They buy it for cash and then they lease it back to you, and you have up to 36 months to buy it at a predetermined price. So if you buy it within 12 months, it's one price. Within 24 months, another, and 36 months, you're paying a portion of the appreciation to them. Most often, it's advantageous to you, though. Especially of late, there's been more appreciation in general. And then lastly, a portion of your monthly payment goes towards your future down payment. And if for some reason you decide that you don't want to buy the house after one of those increments in the lease, if you leave the property, you get the lion's share of that monthly escrow savings back. There is a small penalty, but happy to walk you through that in detail if you have questions. 561-291-8569. Drew, give me a shout during the week. Dom, what do we have?
Michelle sent us a text. Our credit scores aren't great, but we make decent money. Are there any loans we should be asking about? We're not first-time home buyers.
Hey, Michelle, that's a great question. So I'm going to slow this one down a little bit because FHA is a great loan program for somebody who may have a slightly lower credit score, maybe a little bit higher debt to income. But you mentioned in your question, you've got a slightly higher debt to income ratio. But you mentioned in your question, you have the income. So FHA. Now, I said FHA and everybody says, wait a minute, they're not first-time home buyers. FHA doesn't require you to be a first-time home buyer. You can use an FHA loan back to back. And just for clarification, the government guidelines determine first-time buyer by anybody who hasn't owned in the last 3 years. So even if that old, and where the confusion comes from is it used to be a guideline where even in the old days, if you hadn't owned in the last 36 months, you could still use that FHA program. So I encourage you, give us a shout. I'm happy to walk you through that scenario. But the FHA loan allows for a slightly lower credit score, a slightly higher debt to income ratio, which means more of your monthly expenses can eat into more of your income with an FHA loan than a traditional or what's called a conventional loan. And then the interest rate with the FHA loan is usually a little bit better than conventional anyway. So happy to talk you through that. Also, gift funds for down payment. There's a lot of advantages to that loan program. And in the past, people were shying away from it because sellers thought it was complicated or there were things that they were going to have to repair on the property. All misconceptions, but nonetheless, as the market is starting to balance, more and more people are going to look to that FHA product. So hopefully that answers your question. Not a first-time home buyer program anymore. FHA can do the trick for you. So let me throw it over to Dom and see what we have teed up question-wise.
Another text. This is from Samantha. We want to help our son buy a house, but we don't want to be on the mortgage. Do you have any suggestions?
Hey, Samantha, that's an awesome question. So again, I'm going to need a little bit more information because I need to know where your son needs help. If it's down payment and that's the only place he's lacking, then you can gift the funds to him. And that's awesome that you want to help him get into a home. So if it's a down payment issue that he needs help with, then you can provide gift funds. If his income isn't supporting him qualifying, but it's close, let's say he qualified at 4.5%, but he doesn't qualify at 5.5%. Some of those gift funds could be used to buy down the interest rate. So that's another way you could help without going on the loan. Outside of that, if he needs your income and your assets to help him qualify in a significant manner, then you would be classed as what's called a non-occupying co-borrower. However, that puts you fully responsible for the loan. Even though you're a co-borrower, you're each, fully responsible. So if for some reason he didn't make the payment, it would affect your credit. And I'm guessing by the tone of your question, that's your concern. Because one other option is if you're able to do this, you could buy the home in your name and lease option it back to him and then gift him the equity. And there's no limit on equity gift. I mean, if you leased it to him for 3 years and the property doubled in value, you could gift him all of the equity. We've done that on many occasions where a child has made an arrangement with their parent, and the parent gifts them the equity position above the mortgage amount. And sometimes it's a couple $100,000. So you buying it outright, leasing it to him, and then him purchasing it with a gift of equity.